Everyone knows the artificial intelligence boom needs more GPUs. That is the headline, but it is not the whole story. Because behind every GPU cluster, there is a quieter layer that almost nobody talks about: the connectivity layer. The tiny chips, switches, and data pathways that let those GPUs actually talk to each other. And that is where Astera Labs becomes one of the most interesting and most dangerous AI infrastructure stories in the market. On the surface, the company looks almost perfect: high revenue growth, huge gross margins, real profitability, and a balance sheet that does not look like a debt crisis. But buried inside the filings is one risk that can completely change how a retirement-focused investor should look at this stock. One end customer represented more than 70% of Astera's revenue in fiscal year 2025, and the top 3 end customers represented roughly 86%. So the question is not whether Astera is benefiting from AI. It clearly is. The real question is whether investors are buying a diversified AI platform or a brilliant supplier still dependent on a very small number of customers. Let's look at the real numbers. Here's the thesis. Astera Labs is not a weak business. In fact, it may be one of the cleanest pure-play AI infrastructure suppliers in the public market. But the stock is not just a bet on AI connectivity. It's also a bet that a small group of hyperscale customers will keep buying at scale, without pushing margins down, without delaying orders, without redesigning their systems, and without shifting to a different architecture. That's the investment risk. Not the product, not the market, the dependency. Think of an AI data center like a massive factory floor. The GPUs are the workers. The servers are the production lines. But if the communication layer is too slow, too messy, or too power-hungry, the entire factory loses efficiency. Astera Labs sells part of that communication layer. It helps AI systems move data across the rack, across servers, across accelerators, across the infrastructure that makes large-scale AI possible. The company describes its platform as semiconductor-based connectivity for rack-scale AI infrastructure. That includes PCIe, CXL, Ethernet, UA-Link, NVLink Fusion, and software that helps manage complex AI systems. That sounds technical, but for investors, the simple question is this: can Astera become the neutral plumbing layer for the AI factory, or is it still too dependent on a few massive customers? The growth is real. In the first quarter of 2026, Astera reported $308.4 million in revenue. That was up 93% year over year. This is not a pre-revenue concept stock. This is not a story stock with no operating proof. This is a company already converting AI demand into real sales. And the margin profile is unusual. Astera reported a GAAP gross margin of 76.3% in the quarter. That is not normal hardware manufacturing economics. That is closer to a high-value semiconductor platform, a business where the company is not just selling parts, it is selling scarce engineering leverage. And unlike many speculative AI infrastructure names, Astera was profitable. GAAP operating income was $61.8 million. GAAP net income was $80.3 million. So the bear case cannot be lazy. You cannot simply say this company loses money, because it does not. The real risk is different. The risk is not whether Astera has a product. The risk is whether the market is valuing current demand as if it is already diversified, durable, and repeatable. And the filings tell a much more complicated story. Start with the reported numbers. Astera's first quarter results were excellent. Revenue was $308.4 million. Gross profit was $235.1 million. The business is scaling quickly, and the gross profit pool is already large enough to fund serious research and development. But that research and development spend is not optional. In the first quarter, Astera spent $125.6 million on research and development. That tells us the company is still in an arms race. Because in AI infrastructure, the winning product today can become the legacy product tomorrow if the architecture shifts. This is why the Scorpio product line matters. Astera said its Scorpio X Series 320-lane AI fabric switch is now shipping. The company expects the production ramp in the second half of 2026. It also said the broader volume ramp for several Scorpio P Series variants is targeted for 2027. So today's valuation is partly pricing a future ramp that has not fully shown up in volume yet. That is not necessarily bad, but it does mean investors are paying for execution, not just past results. Now watch the margin signal. For the second quarter of 2026, Astera guided revenue to a range of $355 to $365 million. That is strong, but it guided GAAP gross margin to approximately 73%. That is still a very high margin, but it is lower than the first quarter. And for a stock with elite expectations, even a few points of gross margin movement can matter. This is the first investor filter. Astera cannot just grow, it needs to grow while proving that its margin structure is durable across different customers, across different product generations, and across different AI architectures. Otherwise, the market may be capitalizing peak demand as if it were normal demand. Now comes the number that changes the entire story. In Astera's 2025 Form 10-K, the company says one end customer represented more than 70% of revenue. It also says the top 3 end customers represented approximately 86% of revenue. That is not a small footnote. That is the center of the investment debate. A company can have great margins and still carry fragile revenue quality if one customer controls the majority of demand. This does not make Astera a bad company, but it does mean the stock should not be analyzed like a fully diversified semiconductor platform yet. It should be analyzed like a high-quality company, still passing through a concentration risk test. The quarterly filing adds another layer. In the first quarter of 2026, 5 direct customers each represented at least 10% of revenue. At first, that may sound more diversified, but Astera also explains that some of these customers are manufacturing partners buying on behalf of end customers. So you cannot simply look at the direct customer table and assume the end customer risk has disappeared. This distinction is critical. The invoice may go to a manufacturing partner, but the real economic demand can still come from a hyperscaler or platform customer behind that partner. That is why the end customer concentration disclosure matters more than a surface-level customer list. Now listen carefully to the risk factor language. Astera says its master agreements generally do not require end customers to buy a minimum quantity. It also says some end customers may redesign their systems to use fewer of Astera's products, or none of Astera's products, sometimes with limited notice. That is the hidden asymmetry. A design win can create a huge revenue ramp, but it does not guarantee permanent demand. And that matters because Astera also says it can take up to 2 years from a design win to the start of volume commercial shipments. This creates a delayed feedback loop. Investors may see announcements and assume the revenue is already locked in, but the filing reminds us that qualification, customer deployment, and volume timing can stretch across years. We saw this same structural pattern in our recent deep dive on Cerebras. The market wanted to focus on the AI story, but the real question was whether concentrated demand could become repeatable, diversified revenue. Astera is a different company. It has stronger public company profitability, it has cleaner margins, and it has a much stronger balance sheet profile. But the pattern is similar. When one customer can move the revenue curve, the investor cannot just model growth. The investor has to model dependency. To be fair, Astera's balance sheet gives it room to execute. At the end of the first quarter, the company had roughly $1.2 billion in cash, cash equivalents, and marketable securities. Total liabilities were only about $165.3 million. So this is not a debt crisis story. That matters because a company with a strong balance sheet has time to invest, absorb volatility, and build a wider customer base. Cash flow is also encouraging. Astera generated $74.6 million of operating cash flow in the first quarter. That's a real positive signal. but accounts receivable moved against the company by $51.8 million. That happened largely because product sales were higher and collections timing changed. That is not automatically bad, but it is a reminder that revenue growth still needs to convert into cash consistently. There's also one named strategic relationship investors keep watching: Amazon. Astera disclosed a transaction agreement with Amazon. It also disclosed a warrant agreement that allows Amazon's investment affiliate to acquire up to about 3.26 million shares at an exercise price of $142.82. That's an important relationship, but this is where discipline matters. That filing does not, by itself, prove that Amazon is the unnamed end customer behind the 70% revenue concentration. Those are separate facts, and they should not be merged without evidence. This is where disciplined investors separate evidence from storytelling. The evidence says Astera has an important Amazon agreement. The evidence also says one end customer represented more than 70% of 2025 revenue. But unless the company identifies that customer, a conservative investor should not pretend to know what the filing does not say. So, the fundamental proof is mixed. The business quality is high. The growth is real. The margin structure is excellent. The balance sheet is strong. But the concentration risk is not a footnote. It is the core variable. It determines whether Astera deserves to trade like a diversified AI platform or like a brilliant supplier still dependent on a small number of system decisions. For a retirement-focused investor, Astera Labs should not be treated as a simple momentum trade. The checklist has to be unemotional. The question is not, is AI demand strong? The question is, how much customer concentration risk are you being paid to accept? The buy case becomes stronger if four things happen. First, Astera keeps revenue growing while gross margin stays near the low to mid-70s. Second, the Scorpio ramp converts from shipments and design engagements into visible volume revenue. Third, customer concentration declines over time, especially at the end customer level. And fourth, operating cash flow keeps following net income instead of lagging behind it. That would tell investors something important. It would suggest that Astera is moving from a high-quality supplier toward a more durable platform. The weight case is simple. Astera may be an excellent company, but the stock can still be risky if the market is already pricing diversification before diversification is proven. If one customer still drives the majority of demand, the investor needs a margin of safety, not because the company is broken, but because the revenue base has not yet proven it can stand on many independent legs. The avoid case appears if three warning signs arrive together. Gross margin falls faster than expected. The key product ramps push out without enough offsetting demand, and customer concentration remains extreme while operating expenses keep rising. That combination would mean the market is paying for an AI platform while the financials are still behaving like a concentrated supplier. This is the nuance. Astera is not a low-quality business. Its first quarter numbers are impressive. The balance sheet is strong. The operating model is already profitable. But high quality does not remove risk. It only changes the type of risk investors must measure. For long-term investors, the danger is not missing a perfect stock. The danger is paying a perfect price before the company has passed the diversification test. That is the filter. Astera has to prove that the AI connectivity boom belongs to the platform, not just to one dominant customer cycle. The Astera story is not about whether AI infrastructure is real. It is real. The numbers prove that. The real question is whether the market is confusing a high-quality supplier with a fully diversified platform. And if you think a 70% end customer exposure is dangerous, the next AI stock risk is even more extreme because inside the Cerebras IPO story, the same dependency pattern shows up with even less public market history, even more narrative pressure, and even less room for a retirement investor to make a mistake. Click the video on your screen right now to see the Cerebras customer concentration trap before you risk your capital.